Hey everyone, it's Justin from Number Crunch Nerds. Welcome to Members, Updates, and Clarifiers for June the 21st, 2025. So let's hop right into it with clarifier number 1. When you're working in the personal tax planning template, remember that if you have the $3,000 of capital loss that they let you deduct every year, that is going to go right here under the short-term capital gain line inside of the ordinary income section. In fact, I'm going to change the caption right here to short-term capital gain or up to $3,000 of capital loss. The $3,000 of capital loss does not go down here in the long-term capital gain section. The tax law allows you to deduct up to $3,000 of capital loss against ordinary income. Therefore, if you are deducting this against ordinary income, it has to go up here in the ordinary income section. Let's do a quick concept check. Will you ever see a loss, a capital loss, down here in this section? And the answer is no, you will never see a capital loss down here in this section. Why is that? Because if you have a net capital loss, meaning you have more capital loss than you have capital gain for a given year, or you have capital loss carryover from a previous year, you can only deduct up to $3,000 of it in a given year, and that $3,000 is deducted against ordinary income and therefore goes up here in this line. So down here you can only ever have a gain. In this line, you could have a gain or you could have up to $3,000 of capital loss. Let's hop back over here and do an example. Okay, number 1, you had ordinary income of $200,000 and a $40,000 long-term capital loss in 2024. Number 2, you are expecting ordinary income of $200,000 and a $25,000 long-term capital gain in 2025. There are no other items to consider in this example, and the question is, what is your capital loss carry forward to 2026? Okay, we have a couple options here. You could phone a friend, that's option number 1. You could also go 50-50. I'm just kidding, I'm not going to have you phone a friend. They probably don't know the answer anyway, so let's go over this capital loss carry forward example. Starting right here, your 2024 capital loss generated was $40,000. Then your 2024 capital loss used against 2024 ordinary income was $3,000, and that leaves a 2024 capital loss carry forward to 2025 of $37,000. Before we continue, let's make sure we understand where these numbers right here are showing up on the personal tax planning template. Number 1, where does the $40,000 of long-term capital loss generated go? And the answer is nowhere. It does not go on the personal tax planning template. We already said that a long-term capital loss does not appear down here. Where it goes actually is onto a capital loss carry forward schedule, which we're going to talk about in more detail in just a moment. We can pretend for the moment that this right here is our capital loss carry forward schedule. So this is where the $40,000 will appear. What about this $3,000 here that is being used up against ordinary income? Well, we just went over that. That goes right here on this line in the ordinary income section. And then where does this $37,000 go? It doesn't go anywhere on the personal tax planning template itself. It remains on the carry forward schedule where it is right now, so that it can potentially be used to offset other capital gains in the future. Okay, next up, 2025 capital gain generated of of $25,000. This $25,000 of long-term capital gain that was just generated is being offset entirely by this $37,000 of capital loss carryforward that we have right here. And so the result is our 2024 capital loss carryforward remaining after offsetting 2025 capital gain is $12,000. Then, of course, we have our 2024 capital loss carryforward being used against 2025 ordinary income. That amount, of course, is $3,000, and it will appear in the short-term capital gain or loss section in the ordinary income section of the personal tax planning template that we just went over. So that $3,000 being used up offsets this $12,000 of carryforward that is remaining, and the result is 2024 capital loss carryforward to 2026. The amount remaining is $9,000. By the way, did this $25,000 of long-term capital gain generated in 2025, did this item appear anywhere on the personal tax planning template? And the answer is no, it did not appear anywhere on the personal tax planning template because it was offset already here on the carryforward schedule by this $37,000 of loss carryforward. Therefore, there was nothing left to go in the long-term capital gain section of the personal tax planning template. So just to summarize, of everything that is right here on the schedule, the only things that are going to actually appear on the personal tax planning template are this $3,000 of loss in 2024 and this $3,000 of loss in 2025. Also, last thing to note, just so there is no confusion, on this carry forward schedule, I have these $3,000 reductions to the carry forward as positive numbers over here on the personal tax planning template, because all of these other items which are income or gain, these are all positive. Losses will be shown as a negative number over here. Also remember that the Number Crunch Nerds capital loss carry forward tracker is included in the members area. I also just put up a brand new video in the members area dated today with more capital loss examples and how to use the tracker examples. It's a great 2025 refresher for those of you with any capital loss carry forwards, so go check that out at your convenience. In addition to that, there are also new update videos in the members area right now on the following topics. Number one, we have an update to the net investment income tax calculation. And number two, we now have the additional Medicare tax calculation populated within the personal tax planning template. The new section for the additional Medicare tax will be right down here below the net investment income tax calculation. Remember, the additional Medicare tax calculation doesn't apply just to seniors. This can apply to anybody. It just depends on your income, but as I said, we now have that incorporated into the personal tax planning template. And by the way, I should note, I have heard from a lot of you this week about various items, and I have looked at some of your templates for those of you who are having trouble reconciling your 2024 tax returns. And I have to say that everybody looks like they're doing a really good job. I've seen you personalizing the template with multiple rental properties, multiple retirement or brokerage accounts, and after a few small tweaks, in some cases, we're getting 2024 actuals in the template to agree to your 2024 as filed tax returns down to the dollar. So I just wanted to bring that up because it's great to see so many of you getting started on your 2025 tax planning, because as I've said before, in a tax legislation year, which I'm confident this one will be, everything is going to be crazy in the tax world once the law changes. And unprepared folks will be scrambling at the last minute to figure out their tax strategies before the 12/31 deadline hits. And of course, that is how you potentially make mistakes and miss significant savings opportunities. So it's a great thing, and I'm glad to see so many of you getting ahead of the game. All right, now clarifier number 2 on the tax-free muni bond income example, which was example number 3 in last week's video on tax-efficient investing and asset bucketing. Okay, so we're in example 3, the muni bond example from last week. And if you recall, we had the traditional IRA over here, we had the Roth IRA here, and we had the regular brokerage account over here. Also recall that for this example, I said that the starting point, meaning the amount of money that we were going to contribute to each of these 3 types of accounts, was going to be the same right here at $7,000, $7,000, and $7,000. And a number of you reached out to me and said, hey, I was looking at this example number 3 and I don't understand, or I don't agree with what you're doing right here with the Roth IRA as well as with the regular brokerage. And the folks who said that are basically saying, isn't money supposed to go into a Roth IRA and a regular brokerage account after tax? I mean, if you think about it, back here in example 1, there was 12% tax on the money right here, and so only $6,160 went into the Roth and went into the regular brokerage. Right here in example 2, although the tax rate was different, resulting in a different after-tax amount, it was still an after-tax amount of $5,320 that went into the Roth and went into the regular brokerage. So what's going on over here in example 3? Why are we not taxing these amounts right here and right over here? And why are we putting the full $7,000 in both the Roth and the regular brokerage? Or maybe asked another way, who is right? Is it right the way that I have these set up right here? Or are the people questioning this setup, are they right? And I know I got at least one person right there. That one's right and that one's wrong. Nope. Neither one is right or wrong. They're only right based on what we're talking about. Let's go through this example one more time, and we're going to do both scenarios. We're going to do the way that I have it set up, and then we're going to do the way that these other folks have suggested it be set up. So starting with the way that I have it set up right now, my purpose right here in example number 3 was to demonstrate what happens when you generate tax-free income from municipal bonds, and then you invest that tax-free source income into the 3 different kinds of accounts that we were demonstrating in this video. And then also within the 3 types of accounts, we're continuing to invest in municipal bonds, which generate tax-free income. So basically everything in this income, both the source income that funds the accounts, as well as the investments within the accounts, all of it is municipal bonds and all of it is tax-free income. I thought I made that point clear in the original video, but maybe I didn't. So if that is the type of income that we are talking about, then basically you have $7,000 of income, but that $7,000 of income is not a taxable item because of the type of income it is. Not because you're taking a deduction related to the contribution to a special kind of account, but because the type of income itself is not taxable. What I probably should have done just to avoid confusion in this example is cross off this tax return completely and then just have a note here that says you generate $7,000 of tax-free interest income annually from municipal bonds that you are using to fund these accounts. And so with that clarification, this $7,000 $7,000 is after tax. In other words, the after-tax value of $7,000 of tax-free interest income is $7,000. And that is what we are putting into the Roth as well as into the regular brokerage over here. And so when we go down to the results, that is how we are ending up with this after-tax value of the $243,035 in both the Roth and the regular brokerage, but only $184,706 over here in the traditional IRA. Okay, now what if we set this up the other way as the people who were commenting on this particular example were suggesting? In other words, we're saying that this income right here is not tax-free interest income, basically. This $7,000 is being taxed up front at the marginal rate. The amount of tax is being reduced from the total available income, leaving $5,320 for investment each year in both the Roth and the regular brokerage. Essentially, what we're saying up here is that the source income for the investment is not tax-free municipal bond income. Only the investment made once the money enters these accounts is therefore the investment in tax-free interest income from municipal bonds. So in this setup right here, what is your expectation of the results for these three different types of accounts? Well, scrolling down to the bottom here, you can see that we have $184,706 in all three accounts for this setup. Now, why is that? Why are all three producing the exact same answer? Well, it all goes back to what I've talked about on the channel in various examples and videos previously, and it's that if your tax rate never changes over the course of your life, then there is no difference between any of these kinds of accounts. Previously, I had just been discussing the difference between a traditional and a Roth IRA, and I said that if your tax rate never changes over the course of your life, the answers produced by either one of these types of accounts will be the same. We can see that that includes the regular brokerage account as well, because again, the only difference between any of these accounts is all a tax rate play. The underlying investments, as I always say, the stocks, the bonds, the mutual funds, you can invest in the same ones and get the same rate of return in any of these types of accounts. The rate of return and the underlying investments are not a variable that we are looking at. The only variable is your tax rate. So now with this setup, your tax rate here is 24%. During the contribution years, it's 24% here, it's 24% here. We're investing in municipal bonds that generate tax-free interest income, so we've stated that there's no tax along the way right here, and your exit tax down here from the traditional is still 24%. So in this particular example with this setup, the tax rate is not changing over the course of the example individual's life, and that's why all three buckets will produce the same answer. Okay, now reversing back to this previous setup one more time. Now that I have done this, I've realized that something is still incomplete right here. So I'm going to upload this tab with example number 3 on it. In fact, I'll upload all 5 of these examples right here. And your challenge, should you choose to accept it, is sometime this week, take a look at this tab right here, and based on this new setup that we have right here, what is incomplete on this tab? Something is still incomplete. I will be curious to see. Whoever wants to drop a comment, you can send me an email. You can just keep your Sherlock Holmes sleuthing to yourself. Whatever you want to do. I will be curious to see though, who can tell me what on this tab right here is still incomplete based on this new setup we just did. So for members of the Personal Tax Planning Template Program, all of the updates I've mentioned in this video are now available in the members area. So you can log in and check those out at your convenience. And if you're not already a member, the Personal Tax Planning Template program, including the program itself, plus all the supplemental spreadsheets, calculators, and instructional videos that you've seen me mention and demonstrate throughout the Roth IRA conversion video series on YouTube, is available for purchase in the link in the description below this video. Your purchase helps out the channel and provides you with a tax planning tool set that you can use throughout your life to help minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook. So it's a win-win for everybody. As always, you will get lifetime access to the Personal Tax Planning Template program, including all the updates I make to it over the years. Because remember that without proper tax planning, most Americans will end up paying far too much in taxes over the course of their lives. Not because they want to, obviously, but because for decades when your money was sitting in 401ks, no active tax management was really required. And that mentality rolls over right alongside the money that rolls over from the 401k years into the IRA years, causing many folks to simply let that IRA money sit there so it can get slammed at their highest marginal rates in the RMD years of their lifetime or within the 10 RMD years after their passing. Many folks will do that instead of realizing if they just proactively accelerate some portion of that income into the often wide open brackets of their Roth IRA conversion sweet spot years, that they can save their families thousands, even tens of thousands of dollars or more in taxes by laying out their numbers inside the personal tax planning template and figuring out where their opportunities can be found. As I said, if you're interested in joining the Personal Tax Planning Template program, you can find a link to that in the description below this video on YouTube. Alright, that's going to be it for today's video. Thanks everyone for watching, and I will see you next time.